Welcome back, everyone. My name is Adam. I have Rusmin.
Hello.
Victor.
Hi, everyone.
Thanks for joining us. And today is going to be a very special episode because we hit 50,000 subscribers.
Yay! Champagne?
Champagne, okay, later lah. You can get some champagne. All right, so it's a tremendous achievement. I thank you so much for supporting us. When we started this channel, 50,000 was like
crazy.
I mean, now 50,000, we want to get to another 50,000 and hit 100,000, and then we can get this YouTube thing.
Yes. Help us.
But we're just happy to be here because I think we have a very nice community that it's very balanced in the views. If you look at the comments that we have, they ask very good questions about investing, nothing crazy, no one's like bullish, like super bullish about anything. It's just very balanced views. And there's a type of community you want to build right here.
Yep.
So for this 50K thing, we're going to do a special video where we don't really focus on a particular topic, but we'll ask you questions, all you subscribers. What are your burning questions about investing? It could be about investing, about money, personal finance, saving money, stuff like that. And we put up a poll on YouTube and Instagram. So the YouTube one didn't get a lot of questions somehow, but on Instagram we got a few questions, and we picked some of the I think the ones that I think a lot of people can benefit from, and we're going to answer them during this whole episode. All right, so we're going to start with the main thing. I think this topic basically came up a lot. So I'm going to say a few of these questions, and you guys, I'm going to group them together. So one person asked, with markets hitting new highs, do I wait for a correction or a crash before I deploy my cash? So another person also asked, how do I deploy spare cash in the bull market with prices constantly on the rise? Another person is also asking, with relation to DCA, what do you do when the S&P is at an all-time high? Makes it really painful to dollar cost average in. Yeah. So how would you answer these questions?
I think first, maybe I'll just address this question on the market hitting all-time high. I think if you've been following news lately, especially in the US market, you've seen Dow Jones hitting record high, S&P hitting record high, and so it seems that the market is like hitting all-time high, and you should not be investing, right? So actually, by right, the market should continue to hit all-time high, right? Otherwise, you won't see the new high. Otherwise, your portfolio, especially if you invest in the US, you will not be able to see that positive year-on-year performance, right? So actually, if you look at the past data since 1950s all the way to 2020s, actually, market have hit thousands of all-time highs. Thousand times, okay. Right? So just 2010 to 2020 alone, I think the market hit all-time high for 242 times. This is based on the stats. Okay, so it's not surprising because with inflation, right, a lot of businesses will continue to raise their prices, and then eventually they will make more money, right? And then of course you're going to have an index continue to hit all-time high even in the next 10 years, 20 years. So this won't be the last time you hear market hitting all-time high.
And the index itself is a rebalancing mechanism where only the best companies are in there. So if you don't do well, it gets replaced. So you always have the best bunch of companies. I mean, for the S&P 500 anyway.
So if you're in Japan, market hit all-time high only once for the last 30 years. I mean, that was like the last 3 decades, lost 3 decades, right? So so I think in regards to the valuation, obviously with market hitting all-time high, we have to refer back to the fundamentals, especially for the basket of S&P 500, and look at their combined market valuation and see whether they are expensive or cheap. All right, so I'm actually going to use this Shiller CAPE ratio, basically cyclically adjusted PE ratio. So they actually base it on the 10 years average earning to calculate the market PE multiples for the entire market in the S&P 500, right? And I think if you get to see the data from here, we can see that currently the CAPE ratio is almost hitting 40 times. Actually, I think the new data comes out in the 1st of December, all right? You probably have seen that it will be somewhere around 39 to 40, right? So, and this, at this level, I think we are very close to the level where we've seen in the 1999, right? And that was before the crash of the dot-com bubble, right? But that's not to say that, with market hitting all-time high valuation, all-time high, the market is going to crash in the next year or so, right? It's hard to predict because the economies is doing very well, okay? Especially in the US, you have seen corporate earnings, even among the Magnificent Seven, actually hitting all-time high. So that's why the valuation, I think, have been repriced outward, especially after the Trump won the election, right? And so the way I look at it, right? If you can't find a lot of opportunity, which is likely going to be the case right now, especially in the US market, you obviously will just keep on holding on to the cash, right? Shoving out cash. And then, of course, there are still pockets of opportunities that you may come across. You can still deploy them, but I will do it slow, okay? So instead of like, let's say I have 10,000 that I intend to allocate for this. Instead of going 10,000 everything, for this opportunity, I'll probably do it like 3,000 and then 4,000 and then, of course, another 3,000. Like basically break it down, the purchases, right? So I'll do it slow until the market maybe start to come down sometime down the road.
So you stagger your investments based on the opportunities that come up in the valuation?
Yes, yeah.
Okay.
So generally now I'm more like less aggressive. In fact, I'm more defensive for US market. So I'm more like a net seller rather than a net buyer.
Okay.
Yeah,
Right.
but we're not totally out the market. We're just trimming the position, right? Because if you look back into history, back in, I think, before the dot-com boom, a lot of the value investors, they are out in 95, 96 because they think that the market is very expensive, the valuation is expensive, but the market runs from 96 all the way to 1999 peak before it crashed in 2000. So if you totally out of a position in 95, 96, you won't have the next bull run that goes up, okay? Because you don't know how irrational things will go, right? But you want to always be in the market, but you trim your position as it goes. But it's just that your cash position is more or less, but you're still in the market.
Okay. Yeah, because you just don't know, you just can't predict when it's going to happen. Stay in the game, let it grow. But in the meantime, short cash. Like you say, if it gets more expensive, just hold more cash in percentage-wise. And then if it really happens, then you start deploying if the cash really happens.
And I mean, I think there's also a question where should you like deploy after the crash? All right, but the answer to this question is that no one knows, right? So that's the tricky part. So how do you really approach? I mean, if you're investing, you're going to invest, you have a lot of capital right now. Obviously, you have to, like I said, do it slow, right? You only do it when there's opportunity. If not, I think you can just sit on cash.
Don't be too eager to fire your bullets, basically.
Yes, yeah. I mean, a lot of time people say that don't sit on cash. Inflation is high, and now it's been coming down, right? But I always think that if you do something stupid with the cash because you're in a hurry to deploy them, right, you might end up regretting it later when the market really crash.
Okay.
Yeah.
I mean, you can put in Singapore saving bonds. You got 1 month for you to take out. When
meantime,
crash happen, right,
Yeah.
usually for months. So you still got chance to take out your money, right?
Okay. All right. So I'm going to ask the next two questions. I think I mentioned it just now. Someone was asking, with markets at all-time high, how do you dollar cost average in? Similar question is, how do you time the market or do you not time the market?
Okay.
Yeah.
So to answer the question regarding the dollar cost averaging, right? So basically, when someone do dollar cost averaging, this strategy is they want to get the emotion out of the market. They just every month they just go in, right? Regardless high or low, and you invest a horizon of like 20. I think at least 20, 30 years because a market can be down for 20 years or so. But if you 20, 30 years, I think it's enough for ride the ups and down. Okay. And when you retire, that's the big fun that you're going to have it, right? So if you are really to dollar cost averaging, right, your job is not to look at the market. Your job is to just run the DCA on an automation and keep your emotion out of the market and just trust that the market, the stock market will always go up.
Yeah,
right?
in the US.
In the US, right? Yeah. So far, or you buy into the world index where you believe that the world will go up. Okay, the only risk that you have is the world end. Right? That's the only thing that can kill the world index. Right?
It doesn't matter.
Right? The US, if you are scared of like too concentrated in the US, right? You can go and look at the world index and all this.
I think one great way to get the emotion out of it is basically you set up the automation.
Correct.
Where it just deducts it and invests it automatically.
Correct.
Because if you're going to do it yourself every month or every quarter, you still have to make the action.
Yeah.
And sometimes you get swayed, it's too expensive and stuff like that. Yeah. But you set it up automatic, almost like your CPF. You can't even see it basically. It just goes automatically. And you invest that way, DCA.
Yep.
This is the best way to do it.
Correct.
Yeah. All right. So how would you not time the market?
Not time the market for if you're doing DCA.
Yeah. Okay.
Yeah. But I wouldn't say I wouldn't say that we want to time because it's very hard to time the market. Right? For us, we base things on valuation. If things get too expensive, we just trim. Okay. When it get very cheap, we will go in. That's all. Right. But at any one point in time, right, we still have stock in the market. We are not 100% out of the market.
Okay.
Yeah.
All right.
Yeah, and of course, I also want to add on that maybe I just share. I think back in 2011, there was a friend of mine. I mean, he was trying to time the market. At the time, of course, it was during the Euro debt crisis, and there were a lot of talks that the market might cut into W-shaped recovery, right? Because it just came out from the global financial crisis in 0809. And then 2011 looks like a perfect time for the whole economy just to collapse again, and then that forms a W shape. So at the time, this friend, right, he was thinking that the market might crash, so he exited everything.
100% cash.
100% cash.
Okay.
Right, and he was just waiting for that
Crash.
and then he will pounce.
Yeah.
Right, and unfortunately, there were a lot of bad news at the time. Right, I mean, we were busy deploying our cash because there were a lot of companies that we follow. The valuation comes very attractive, and we started deploying them. Right, rather than trying to time the market, we started to put them to work. Right, but and then that actually proves to be again one of the lowest moment. Right, and then it rebounded. Right, of course, May 2012, I still remember that there was a correction again, but it wasn't as low as compared to 2011. Before the rebound, and that was the low. At that time.
And then it just went all the way.
It just went away. Just compared to 2011 versus now, if you invest in the US market, obviously the market has gone up.
So if that guy, let's say hypothetically, that person, he missed, he cashed out in 2011, 2012 came down, but it wasn't low enough. The next time you could have gotten in was COVID in a way,
but
right?
that's even COVID, if you compare to 2011, let's say if you invest in the US market, I think at that time the low
you
was
missed out all the time, right?
Yeah. That time I think the S&P was around 1001. Okay, even COVID at the lowest was about 2003. More than 2 times.
So you missed out all that gain and the time that you would have
now hopefully he will have. I don't know whether he invested after that, right? Because now it's like.
Maybe he got a Bitcoin, so it's okay.
Right? Yeah. But anyway, the market has gone up like 4 times since then. Right. So rather than trying to time the market, timing your time in the market, or rather staying invested, right? Is I think if you are, especially if you invest in good companies, usually time is your biggest friend, right? So you will want to stay invested and let it compound.
Okay, so I would say we don't try to time the market, but we just look at valuations. What makes sense, we go in. Doesn't make sense, we stay out. And that way, you kind of ride with the market timing because there are valuations involved, but you don't try to predict outright what's going to happen because impossible to do.
Yep.
So okay, now someone's asking. Now we're talking about when to buy and all that. Someone's asking also, how do you know when to sell, and what do you do about losing stocks? How do you know when it's time to cut loss and stuff like that?
So I think when it comes to sell, right, there's I think a few criteria. First is everything must based on fundamental, right? So is the business still in a tailwind industry? If a business is in a headwind industry or is facing headwinds in, let's say, maybe if 1 year I may not want to sell. If you know that the next 3 or 4 years they are going to facing headwinds, the fundamental shift or the business get disrupted, I will sell the business.
Okay.
Right. The next one that I will sell is when the valuation, right, is very expensive. Then I will consider selling the company.
So these are the two instances. Basically, fundamentals they're not so good. You exit. Or it's just way too expensive.
Correct.
You rather lock in some of the profit.
Or the company still have the right fundamental. It's just that they are facing headwinds for the next.
Okay.
Maybe you think that it's like next 3 years they're going to face headwinds. I think I will exit that position.
Okay.
Yeah. And I'll just add on maybe if you come across a better opportunity that the catalyst could be happening in the year or 2 years, and then it makes sense to sell the existing one that is not so good, right? That's under a lot of pressure and then may not perform in the next 3 years. Then you actually swap it to the one that you think have a lot more potential or even cheaper in terms of valuation.
All right.
And you get the same quality.
So you're recycling your capital. Same thing you have a dividend stock, for example, giving you 4%. You can swap it to a 5% yield stock, which is as good. Well, the fundamentals are just as good, but just higher yield as well. Makes sense in that sense.
Yes, You don't sell because Trump got elected, interest rate can go up because inflation can go up.
Okay.
Right. So there might be another repeat of 2022 crash because interest rate was rising at the time rapidly, and there was a correction. Right. So you don't do your decision based on that. Again, it boils down to the stock that you invested, right? And whether there will be maybe under a lot of pressure from the tariff trade wars and all that, then you might reconsider that position.
Okay.
Yeah.
All right. So this is a follow-up question from the same person about losing stocks. How do you pick the best stock? So if you're you've been losing money, then how do you actually pick the best stocks?
Yeah. So I think at the end, when we buy into companies are just like human. they have a certain behavior because it's managed by humans.
Okay.
Right. So if you want to pick the best stocks, right, I think the best stocks are those that are very resilient during the recessions, during the crises, the economic crisis, right? So how do you pick that? It's very simple. You just go back to the past history. You look at those companies with long track record during every crisis. How does it affect them?
Okay.
Right. If every crisis, right, their drops of their revenue and net profit is like more than 20%. These kind of companies are less recession proof.
Okay.
Okay. But then if those companies, every crisis, either they make profit or they just drop a bit, less than 10%. These companies are resilient.
Okay.
So you know that, right, when you buy these type of companies, right, the next crisis, you can ride through it because this company will definitely perform in that crisis because you have seen this history in past all the different crises.
Okay. How do you balance this with, because this sounds like a very defensive kind of stock.
Yep.
Which are many stocks like that, very defensive, even during recessions, they still have to sell because important type of companies. But how do you balance that with growth? Because you don't want to just have resilience and then the growth may be lackluster. How do you balance like something that could also grow at the same time?
That's why you have to look at the company. Do they have the history of growing their revenue? Right? I mean, if you run business for a long time, you will understand that, right? It's not easy to grow the revenue.
Okay.
And not a lot of companies that are listed are able to keep growing the revenue, except I think US, I think you can see more, but the rest of the world is not as simple as it is.
Okay.
Right? So when you look at the history that this company is able to consistently grow the revenue in the past, and they are still in a tier one industry, or maybe the total addressable markets that they are in is still a small market, which give them a longer runway, then you can sort of see a clearer picture that, okay, there's still some growth. I think the revenue trajectory can maintain.
Okay.
Right.
So basically, one qualitative aspect that I look for a lot of businesses that we invest is pricing power. Right. If they have pricing power, right, then they can always raise the prices. If there's a cost pressure, they can pass it down to the consumers, and the consumer will still come back and buy a lot of stuff from there. Right.
Okay.
So these are the companies that I think we look at them. And I think it's even like for the property sector, we also look at like supply and demand. When there's a under supply situation in certain sector, for example, like data centers, right? Especially like in Singapore, obviously the data centers, the landlord will have a lot of pricing power because there's not a lot of supply coming in, and of the moratorium that the government had in place in Singapore, and that leads to, I think, very little supply of data centers. Right, and of course the new supply will come in 2025, 2026, but then that will take some time. Okay, and the market, there's a ready demand available, right? But these are some things that I think you generally to look at. Right, you want to make sure that the companies that you invest have a strong pricing power, or if they are a commodities sector, then you want to get in when the whole sector is like under supply.
So I think these are really good answers about how do you actually pick a great business. I have a slightly different, or not a different, but additional take to this. When someone asks what's the best stock to buy, my initial thought is always there's no best stock to buy because it really depends on you and what your investment goals are. Everyone is different. So for example, what is the best stock? So yes, you can pick a great business, but what is a great business for different people means different things. For example, DBS Bank is a great business.
Yep.
Pays a great yield, stable in that sense. Makes sense for someone who wants passive income. Apple is a great business. Someone who's looking for growth, a stalwart, in the tech industry, he likes that. That's a great stock for the person. Or Nvidia is a great business, but someone who wants more risk, a bit more growth, this high growth area in AI and semiconductors, that's a great business for that person. So what is best? It really depends on you, because for someone who's a retiree and then you say Apple's a great business, but then it doesn't meet that financial goals. It can get really scary for them if, for example, China gets cut off. Apple suffers in that way. So I think I want to, before you jump into what's a great business or what's the best stock, ask yourself what's the best stock for you.
Maybe I just want to jump back to the question where I think the person earlier on, how do you pick the best stock, right? And he or she also asked what to do about losing stock. Right? I think we all, if you invest in the market long enough, all of us will probably have a few stock or one or two, right, that are probably losing money. And Some I think I came across before, people coming to me showing me their portfolio, and I look at them, it's like majority of them are loss making. So sometimes I feel pity for them, because a lot of these stocks that they picked, if you study the fundamentals, they're really like terrible, right? And I have no idea why they invest in them. And usually when I ask them, especially the older generation, I mean in the past like 15 years, 20 years ago, they got a lot of stock tips from their brokers or their friends, and they have no idea why they invest. So in this kind of situation, a lot of time when they invest or they got in at the wrong price, and the share price just tanked 50%, or even sometimes as much as like 80-90%, and they just keep holding on to it because they feel that it might come back one day, right? But the day never comes, right? So I always feel that people who have like there are a lot of psychological at play here, because the fear of like cutting losses is quite real, right? If you invest real money in the stock market, so sometimes if you are in that kind of situation, and if you realize that the stock is really like have no future, the best thing to do is always like to move on, get it out from your portfolio, move it on, and take the money that you have sold. It could be like just 10% of the original value or 50% of the original value. You can still take the money, go invest in better quality stocks that might make back the money that you have lost it in your the first stock.
Yep.
You don't have to make back the money the way you lost it. If you lost in A, you can you don't have to wait for A to come back, right? You can go for find a B that is like, it's fantastic.
Okay.
And then the B could have actually compound back your losses, right? So I just want to address this, because sometimes I actually encounter a lot of people who are holding on to their loss-making stock. If they are lousy stock, right? If they are good stock and they are loss-making, I think it's perfectly fine to continue to hold them. And if possible, you can add them if there's a room for further allocation for that stock itself.
Okay, so since I mentioned DBS Bank just now, I think someone also asked similar things about OCBC, so about Singapore banks basically. Can we have an analysis on OCBC's share price? When will it drop? And so I know when to buy basically.
Okay, so you don't know when the stock price will drop. Okay, but the one that is really confirmed, is when there's economic crisis, right? Especially when there's economic crisis, the interest rate will cut aggressively. That will affect the bank, and most of the time, banks are affected during financial crisis or economic crisis. So right now, if you look at the valuation table over here for OCBC, you can see that the book value is traded above one standard deviation. So right now, the valuation is I wouldn't say it's too stretched, but it's not cheap, right? So I think to look at a more decent valuation when you want to look at the banks, right, it should be either at the average or below. That's the ideal way to look at the banks.
Okay.
Yep.
Would you look at the yield as well?
Yep. I'll definitely look at the yield. Okay. So make sure that the yield I prefer at least 5 or 6% yield, higher than the risk-free rate of 4% that we have in the SA account.
And the CPF. All right. Okay, so that's a nice segue, because another person basically asked, how do I use my CPF to invest? So for Singaporeans who are watching this, who are interested, they have like some money in CPF that they're sitting away in there. What can you do with it? Okay,
so first you need to fulfill the criteria before you can invest using your CPF money. The first thing is you must be above 18 years old, right?
Okay.
And you're not bankrupt,
Wow.
okay? And you have to complete this self-awareness test, CPF self-awareness test inside. So then you can invest, okay? In the past, we don't need to do, but right now you need to do. Okay, so you need to do that. So that's the first thing you need to make sure you eligible first. The second is you need to open a CPF investment account with only one of the three banks, OCBC, UOB, DBS. You can open with one of them. You don't need to be a customer of the thing, but you can open a CPF investment account with them. So now it's much easier to open because you can do it online now. Okay, in the past you have to go down to the branch, you have to queue up, and now you can do it online. So
I hate queuing
easier,
at the bank, man.
Okay, so if you see the CPF investment account, based on the charges, if you were to trade through them, you still need a broker to link up with this CPF investment account, but they will act as an agent for you.
Yeah.
Okay, so they do charge you some fee. So I'm going to flash the table here over, right? You realize that out of these three banks, right, one of them is the cheapest among the three. The bank that starts with the letter U,
UOB lah, I say.
Yeah, you can see from there like I no need to. You can see from the comparison, right? Okay, in the past, before this is actually they increased the price. In the past is also UOB. So actually OCBC and DBS they actually increased the price of the charges.
Okay. But the minimal, they're not too expensive. Right?
Yeah, correct. So that is the criteria before you can start investing. So when you start investing, right, you need to know that with your OA, right, when you start invest, right, example you got $50,000 inside your OA account. So CPF will use two criteria to judge. Okay, the first criteria is the first 20,000 cannot invest. So let's say you got 50,000, the first 20,000 can invest. So the amount they can invest is 30,000. So that is the first sum that they will deduce. The second method they do is they will take 35% of the 50,000, which is 17,500. So whichever lower they'll take. So that means the amount you can invest is not 30,000 but 17,500. Okay, but don't worry, this is the method. But how much you can invest? Very simple. You just log on to my CPF and you click on the investment. I already screenshot here over for you. Then you'll reach your ordinary account inside. Then you just click on amount available for stock and gold. They'll tell you the amount that you can invest for your CPF. Okay. So once you have done all this step and you are able to invest, right, the next thing is, right, the stocks that you can invest. Okay. So you only can invest in CPF approved shares. Okay. So when I say CPF approved share, is the company must be incorporated in SGD, must be listed on the main board or the catalyst. Okay, must be SGD traded. Okay, then you must have the CPF agent bank, which is either one of the three bank, and they are not in the SGX watch list. Okay, so for instance, let's say example Hong Kong Land, or your Thai Beverage, or your Jardine Matheson, right? You cannot invest
because it's
CPF
USD.
because it's USD, and Thai Beverage is not incorporated in Singapore.
Okay.
But your Jardine C&C you can invest because that's in SGD and incorporated in Singapore.
Okay.
So there's a list that you can search in SGX. You just search stocks under CPF investment scheme SGX. You'll know which stocks you can invest over there. Okay, there's a big list over there. Okay, so after you have done this, you know the stock that you invest, right? The first thing you need to know, right, is what to avoid and what to look out for when you invest using your CPF money. Okay, the first thing that you need to avoid using your CPF money to invest is the REITs. Okay, why? Because from time and time, right, the REITs may call for rights issue or they will raise money from you.
Preferential offering.
Or preferential offering from you, right? Because your CPF money, right, is limited. There's a cap to it, and it's based on the amount that is inside. So once you hit the threshold, you cannot. So if you already reached the threshold and they raise the rights, you're gonna have to either, I think you have to top up or something, or you cannot do it. Okay, I'm not so sure on that. You have to check with CPF. Okay, but it's very troublesome. Okay. So I rather you don't do that. So avoid all this. Okay.
So is that because you want to avoid dilution in your investment?
Yes, correct.
But then sometimes the REITs do rights issues in a way where you don't get diluted on a DPU basis. That's okay,
correct.
right?
That's okay.
But you never know.
Okay.
Right, whether they will do rights issue or not. Okay.
Only certain REITs that always do preferential offering. Avoid those that have always issuance of rights. So you can look at their history.
Hint. Okay.
Yeah.
Okay.
Second is you avoid investing in cyclical or project-based companies because these companies tend to go up and down, cyclical, based on the cycle, right? Because your CPF money, right, I would say it's a hard-earned money. It's compounding there 2.5%. Right? Your job is to beat 4%. Because if you can't beat 4%, then I'd rather you transfer everything to SA.
Yeah, special
right?
account. Yeah.
Which is your thing. So you are basing on this opportunity cost that you have, the 4% opportunity cost, right?
Yeah.
So you want to focus more on defensive companies that give you like 4% yield, or you know that you can grow 4%, more than 4%. You're not targeting for 4%. You're targeting for plus 2%, 6%.
Okay.
Right. So that's the target you must give yourself. If not, I'd rather you do nothing and put it in an SA.
Yeah,
okay. And ideally, I feel you should look for dividend companies. They're generally more safe and more stable. Okay. And you want to look for companies that are more predictable, recurring, defensive, and you don't want to buy into companies that have too high in the debt. Because if they're too high in debt, right, they will end up having to pay the debt, and the share price may be tank.
Yeah.
Right. So you want to focus on strong balance sheet companies. So these are the few criteria that you can look at.
Okay. Yeah, I think it was a very good summary actually. So about how do you invest using your CPF.
I feel like Victor is a CPF spokesman.
I mean, because I invest using the CPF, right? Yeah.
Yeah, I think you've talked a lot about how do you invest using CPF.
We even did a webinar on teaching how to invest with CPF.
Yeah, so if you're on our newsletter list, sometimes you get emails from us about those exclusive webinars we have for email subscribers.
Yep.
You can go to fitperson.com/newsletter, I think. And you can subscribe to our list. And Victor, Rusmin, sometimes we do webinars at night, free, entirely free.
Yep.
Hour long.
Hour to 2 hours.
Hour, 2 hours.
Yeah, so the
free.
CPF one, I usually do once a year.
Okay.
So if you miss the previous session, you can wait for next year.
Yeah. So actually, this YouTube thing once a week, we actually have more stuff if you subscribe to our list. So do check it out. All right. So I think we want to wrap it up. This is the last question here. For the average person, what are the monetary milestones to hit after you start working?
So we basically did a video on getting your first 100,000. I think you can go and take a look, right? So the ideal case is we say that you should aim to get your first $100,000, and we did, like I said, we did a video and show it. Actually, it's very achievable in the current circumstances that we have, right? With so many high yield SSB and all this.
100K by 30 years old, right?
100K by 30 years old, you can. So I think that should be your target. But if you want to challenge yourself, like, because in the past, right, 100,000 during my time, right, is about 2.7 times of the.
How old are you, man? What I mean during your time?
During when I was young in the 20s, okay. During the time when I was in the 20s, right, it was about 2.7 times of the 2.7 times of the annual median income.
Yeah.
Okay. So if you base on the current median income right now of 2023, it's about 5,197 on a monthly, right. So if you annually, right, the 100,000 is actually less than that.
Mm-hmm.
So if you base on 2.7, that should be a rough figure. I mean, if you want to be more challenging, you should be about, let's say, make it simple, 3 times. So that I think will be about 180,000.
Okay.
Inflation
about
adjusted.
There, I remember. Yeah.
Inflation adjusted. Yeah.
So we did a video about this, about how you can hit 100K by 30. Do check out that video as well. And we basically share how it's very achievable for most people.
Yes,
I mean, of
correct.
course, you have personal circumstances that makes it really hard. Health issues, family issues. We totally understand. Not everyone is, you know, things can happen.
Yeah.
But if, 100K by 30, including your CPF and everything, should be able to hit that. And then that forms the foundation of your asset base.
Yes.
Start investing more, start accumulating again, let it grow. So that is the milestone most people can hit when they start working.
Correct.
So like 5-6 years after they start working, should be able to be, achievable. Beyond that, it's really up to you. Like 1 million by 40 and stuff like that.
Yep.
Depends on how you invest, your career and everything. So there's going to be a bit more open-ended. We will do a video on that maybe one day, right, guys?
Yeah.
All right, so I think these are the questions that we have today. We just wanted to pick some of the good ones that I think will help a lot more people. And then, have both of you guys just answer them. It's really, really helpful. Again, it's good. I mean, some of the stuff maybe you already know, but good reminder nonetheless to hear all these things again. Again, it's good for us to also share. I think the CPF one, we haven't touched that for some time as well.
Yep.
So I think that for those who don't know, this is how we view how you should invest your CPF.
Yep.
Okay, so with that, I hope you really enjoyed this webinar. I think thank you once again for like 50,000 subscribers.
Yep.
It's
Thank you so
amazing
much.
to think that we could theoretically fill a stadium with all of you guys.
Nice perspective.
Yeah, think about it, right? And not everyone's from Singapore. You have people from Malaysia and in Southeast Asia and US, UK as well.
Yep.
Australia. So thank you everyone for watching our nice little channel here that we want to share about how you can basically invest, make better investment decisions for yourself and your loved ones. And we will continue doing this for many years to come. So thank you for being with us on this journey up to this point, and we're going to go on to the next milestone, which is 100K.
Yep.
Next time we do a countdown, okay?
Yeah, okay.
9,999.
Yeah, let's see whether we can do it.
100,000. Then we do that.
Yeah, okay. All right, so we look forward to that. So thank you once again. My name is Adam, Rusmin, Victor.
Thank you.
Thanks for joining us. Any questions you want us to answer some more, we can put them in the comment section. We can answer them for you. Of course, please hit this like button. It will always help us with the algorithm on YouTube, and subscribe to our channel so we can get to the next milestone. All right, so thank you so much, and we'll see you again.